Hello everyone, very good morning and thank you for joining on Sunday morning. I appreciate it and hopefully I'll add some more value and share the mental framework that I use while analyzing business. So the company that I will be talking about is Shivalik Rasayan. Before going into it, a standard disclaimer, I being the opener for today, I think this disclaimer will hold true for all the participants. But yeah, I mean, whatever we are sharing and discussing, all this like a business case study and not recommendation. Neither I am SEBI registered. I am far from it. I am a tech and communication guy, but have a passion for equity. And all the financial data performance analysis is actually taken from a publicly available information. So now that the disclaimer is taken out, let's move to the core topic. So Shivalik Rasayan, um, the core thesis is a structural pivot from an agrochemical core to high potency pharma ecosystem. The flow of this presentation shall be, we will go through these 10 core points. What is the business cycle currently? The leadership of Shivalik Rasayan, the asset quality that they hold. Uh, while all of this is okay, but if there is any mode or if they are in a process of building any mode, operational parameters, vertical integration, then how things will shape up over next 3-4 years. What is the inflection point that I see? Risk metrics, then what needs to be monitored to see whether the thesis is going as expected, and then quick question round. But prior to going there, I think we can spend a minute on this particular slide. All of you or most of you must be knowing the Chinese bamboo tree. So, whenever we study any business or do any business analysis, there is a mental framework that each of us individually use, and we try to understand that business from that mental framework. So, this is an important slide where if you could see what happens with Chinese bamboo trees, despite your daily kind of watering, fertilizing, sunlight, and all of the resources that it requires for a bamboo seed, it shows zero visible growth above the soil for first 4 years. So you have sown the seed for 4 years. You are nurturing it, doing everything you can do, but on the surface you are really not able to see any visible growth. But under the soil, underground, the plant is not dormant. It is building extensive, deep, robust root network beneath the surface to sustain how it can grow in future. And then in the fifth year, in a matter of 6 weeks, the tree shoots up 80 feet tall from the ground. So, when I study a business of Shivalik Rasayan, I thought that there is a lot of resemblance to how this parable of Chinese bamboo tree happens. But not only Shivalik Rasayan, uh, currently there are multiple businesses where such mental framework can be applied. So somebody like Suven Life Science of Mr. Jasti or Khorakiwala of Wokhad or Arun Kumar of Solara. So what I will be presenting on Shivalik Rasayan, you guys can apply this framework for other three businesses as well, and you will find interesting insights. So remember the parable of Chinese bamboo tree. We will connect the dots in the presentation. So, what is happening in Shivalik Rasayan? So, by nature, Shivalik Rasayan is a agrochemical business, low margin, organophosphorus, tech generics, dimethoate and malathion. Some words are like tongue twisters, but please keep up with that. And this is what the old identity of Shivalik Rasayan. What is happening currently? So, when we use the word pivot, what is happening at present? So, currently, the heavy capex deployment that they planned has been completed for their pivot from a commoditized agrochemical business towards a high potency pharma business. And along with that, the plant level audits have also been cleared. The US FDA EIR and initial EDQM CEPs have been secured. So just to help you, EDQM is European Directorate of Quality Medicine and Healthcare, and CEP stands for Certificate of Suitability. So US FDA for US market, EDQM for European market. And they have also pivoting in future towards high margin pharma scaling. So the infrastructure is ready, the plant level audits have been cleared, and the future will have commercialization of complex onco, non-onco APIs and global generic CDMO expansion. So operating leverage blowout phase. So this is the thesis in one single slide of where Shivalik Rasayan was in the past, where it is currently, and how the future will look like. Now, let's understand it in a more nuances of what it exactly do currently and how the future pivot will work out. So, its foundation business is not a structural story. It is a fiscal engine. So, what Shivalik Rasayan is doing, they have a very high quality agrochemical business, very high ROC, cash generating, and what they are doing is without taking any leverage or unnecessary dilution, they are using this foundational business and the cash that is generated from it over the last few years to invest into their pharmaceutical transformation. So, in their existing business, they are the largest producer of dimethoate technical and second largest for malathion technical. Um, what these do, these are like industrial grade protective shields that keep the bugs away from eating crop. So that is their current bread and butter business. Very predictable internal cash flows, and the current Dehradun plant capacity, they are running 95% utilization, which itself says that the Indian and global market demand they are able to serve, and they have the skin in the game in this business. But this business is essentially while this business is essential, but it's a high volume, but low margin and highly competitive. And most of you would have observed that over the last almost a decade, or we can say like 6, 7 years, the agrochemical cycle hasn't been that kind. You take any business like from PI Industries to UPL to any, and most of them have facing challenges. Having said that, uh, I believe the management was aware. Far earlier than most of us know. And that's why they have started using this steady 8-10% compounder business cash flow to fund the future pivot. So if you see, they have a good enough pharma R&D funding pipelines, uh, initial equity funding gaps for the hedge API blocks, and gestation phase for working. So all the cash flow that is being generated through the steady business have actually been put to increase R&D funding pipelines and the hedge API blocks and gestation. So uh, they are pivoting into APIs with a hyper focus on oncology, especially cancer treatment. So, to simplify it in a layman language, API or active pharmaceutical ingredient, one of the key parts. So, what it is, so whenever somebody takes a pill, 95% of that pill has like chalk sugar or like binding powder, and the actual 5% of the powder that cures the illness is a API. So, it's a magic ingredient. So, as you could understand that they are actually moving from a steady high utilization business toward something which is much niche and into a hyper focus oncology business. So this gives a glimpse of where the business is and where it is pivoting. Uh, while we go in depth about the asset quality and the products and everything, it is very important to understand the promoter pedigree. So those who have been in markets for like couple of decades, they know that Shivalik Rasayan as a business is there from 90s, 80s. At that time, I was not even born. The business was struggling for 20 years, all the way till 2002. And in 2002, Mr. Rahul Bishnoi, who is existing chairman, have actually taken over Shivalik Rasayan. And over the period, he has done what a promoter does to turn around a business. So increasing the top line, improving the bottom line, removing the bottlenecks, strategizing, giving a direction. In a same way, in 2016, Shivalik Rasayan has actually bought 40% stake in Medicamen. Medicamen was a struggling business at that particular time. And they have taken, and we will discuss in our vertical integration slide of how this will all come together. So if you could see, Mr. Rahul Bishnoi, who is a heavily experienced person, has actually a knack of turning around struggling businesses and getting them into a scale. But oncology is not an easy business. So what they did, they went into a market and hired the best possible to strategically architect their oncology scale up. So Mr. Vimal Kumar Sherawat, who is the existing MD, he is a PhD in chemistry and he was ex-CEO of Shilpa Medicare. So he is actually spearheading the US FDA scale up and oncology R&D pipeline. So these are the two key persons. Then operationally, Mr. Suresh Kumar Singh, 30 plus years of chemical engineering experience, and he's managing the high volume legacy agrochemical site in Dehradun. Ashwini Kumar Sharma, he heads the international business alliance and focus on regulated market entry. And Mr. Vinod Kumar, who is a CFO, who is actually managing what we have discussed on the operational efficiency of utilizing the existing cash flow towards funding the high potency pharma business. So this is a very high quality management in my view, very experienced management, right people at right place, taking right steps to make the business future ready. It's not easy to move from agro commodity towards a very high specialty oncology API, but they have taken the bet. So this is about the management. So far we have covered what Shivalik Rasayan is, the parable of Chinese bamboo tree. Then we understood how the business is pivoting from its history towards future with presently being ready with capacity. And we have also studied all the leaders who are actually executing this. Now let's understand the asset quality. So Shivalik has 4 plants, Dehradun, Dahej has 2, Dahej 2 and 3, and Bhiwadi. The Dehradun plant is actually serving current agro technicals. So it is like legacy organophosphorus chemistry. And as we discussed, like stable cash flow engine, fully operational, 95% capacity utilization, which you can see in the second half. So 1450 MTPA capacity is there and 95% utilized. Dahej 2 is a high potency pharma API. So OEB5 containment, oncology, non-oncology product. It's a US FDA approved and scaling commercial supply. So what is OEB5? OEB is occupational exposure band 5. So in OEB, there are multiple layers like 1, 2, 3, 4, 5. So this Dahej plant, which has got a US FDA approved, is OEB5, which means very, very high potency for a very minimal in mg dosage. There could be several health risks. And then even people who are working in those plants, the airborne limit is very contained. Hence, it's not easy to have a OEB5 compliant plant. But this plant, they have recently got US FDA approval, which means they have a huge reliance on compliance, and Mr. Sherawat's fine print is clearly visible. Dahej 3 is for specialty and intermediate. So fungicides, synthetic intermediate. So they are not only moving towards the pharma, high potency pharma, but even in their agro business, they are moving towards a more specialized and synthetic intermediates. And we will discuss that also. And Bhiwadi is for R&D and generic CDMO support. So it is also DSIR approved, 60 plus R&D scientists. So for a 400 crore market cap company, they have 60 plus scientists for custom synthesis hub. So they are putting all the right things in place for this business to transform. Uh, so this is the asset quality. So we saw the quality of management, we saw the quality of assets that they have. The assets have already been built, um, they have been approved, and this is the point where we are currently. Now, let's understand when we say high potency pharma, what is the pipeline that have, because that is the most interesting. We are not looking at a rear mirror, but what is there in the future. So these are very difficult names to take. So please bear with me. So temozolomide, um, it is expected that the global addressable market is 1.44 billion, and Shivalik Rasayan has US DMF validation completed for the same. Then palbociclib is breast cancer drug. It's a blockbuster molecule with global markets is exceeding 5.20 billion. Advanced generic pipeline is already captured, and they are targeting the patent cliff. And busulfan and pyranidone, the combined specialty orphan global markets estimated at 650 million. They have already cleared EDQM CEP, so Europe's certificate of suitability approval is already granted. So, in the regulated pharma portfolio, the drugs that they are working on, there is a large target addressable market to capture globally. Now, this is happening. So, the capacity for these is actually happening in Dahej 2. In Dahej 3, in agro and specialty chemical pipeline, they're targeting very high value intermediate level localized performance chemistry. So premium fungicide tech. So they have scaled deployment of azoxystrobin technical and tebuconazole pipelines, for which the addressable TAM is 18 billion plus. So they are targeting a very high yield export substitute. Also in intermediate, the phenyl glycolate and advanced oxyren lines near validation to scale domestic self-reliance, and dinotefuran and dinotefuran intermediates, next-gen insecticides. So they are also scaling. So as you could see, uh, along with the pharma pivot, even in their legacy business, they are moving up value chain. So these are the like pipeline of products that they are working on and the target addressable market. Um, Now, eventually, they are also pivoting towards becoming a generic CDMO. So, it is leveraging OEB5 high containment infra to actually secure innovator contracts. So, what used to happen here is they will get a technology transfer from the novel players globally, and they will become their contract manufacturer. So, in Bhiwadi plant, as I just said that there are like 60 R&D scientists, and then there's a 40 crore plus investment in advanced instrumentation allowing complex multi-step synthesis, and from lab scale process development to commercial GMP manufacturing. Uh, how the novel players find it beneficial to join with SRL? The cost advantage, obviously, like captive intermediate sourcing from Dahej 3. So it will reduce third party dependency. US FDA provides validation of compliance of the plant. They already have capability to handle cytotoxic compounds that few global CMOs can manage at scale. They have already proved their capability, and obviously it's a margin accretive for the bigger clients. So far we have understood that from legacy agrochemicals they are moving towards high potency pharma, specialized agrochemical, and generic CDMO pivot. So this is an interesting case study that is happening in front of us. Now, While this is all fine, why would have Shivalik Rasayan moved ahead in 2016 and acquired a large stake in Medicamin? So if you could see, uh, there is something called vertical integration, or we can call it like backward or forward integration. So what essentially SRL is doing is they are actually managing complex chemical synthesis and active API isolation. This gives a guaranteed raw material stability and it's the external supply shock. But Medicamin is at forefront. So SRL will act as a backing engine to Medicamin to go and build capsules and end user tablets or end user drug. So Medicamin will convert SRL's API into value add formulation, capture the finally generic retail margins, which are exceeding 50%, and manage global institution oncology hospital tenders. So if you could see, they are not trying to be a one-leg pony, but they are trying to capture the complete value chain, right from start all the way to formulation and selling it to the end user. So just try to think and connect the dot of what promoter is actually trying to do and what kind of long game he is trying to play. It's not at all a quarter to quarter kahani or like uh, something which happens in a very jiffy. It's a very in-depth planning. There is a lot of work that is put in place in terms of vertical integration, in terms of product pivot, in terms of R&D, uh, clearances for their plants. So we understood how SRL and Medicamen are bind together to become end-to-end value chain optionality. Now, let's quickly go to whatever we have discussed so far. If the thesis plays out, how the probabilistic numbers will look like. So I think for FY26, they have already crossed 315. So they will be more than that. These are very conservative estimates that have been taken. But on a larger scale, what I could see that if the thesis plays out, if the execution kicks in, the commercialization becomes successful, the 315 gross revenue top line by FY30 should be somewhere 3x from current top line. So around 800, 2.5x to 3x. And the EPS, which is currently 30 rupees, can easily go to 90. So if the thesis plays out as is, this is how it will move. But another operational parameter that needs to be seen is the EBITDA margin. So there is a strong possibility that if the thesis plays out and the return ratios improve, there is a strong possibility of EBITDA margin expansion, and we will look into that. This is the, I think, most important slide one could look at. So, Shivalik Rasayan legacy business used to operate at 28 to 30% gross margins. The inflection phase should be 35% gross margin, and the onco mix target is 50%. But I'll show you on screener that they have already reached to a 50% gross margin. So the thesis, if plays out, they should somewhere clock 25% EBITDA margin. Currently, if you see a very good double digit high ROE ROC business is currently trading at a single digit ROE ROC because there is a lot of current work in progress, gross block that is happening, which I will show you on screener very quickly. So a high quality business trading at extremely poor return ratios, and if the execution kicks in, This is the point where multi-baggers take birth. Now, in terms of valuation, this business is actually trading at currently 0.75 or something price to book. I am saying price to book. So even if they sell everything, the current price is actually below their book value. But markets being markets, they know much more than us, and they know why in current state this business should be trading at this valuation. But whether the future will be same, that is the question that we as an investor has to study and answer for ourselves. So this is one of the important slide. I suggest you have a look on it and refer whenever you want to understand more. So 0.8 price to book, ROE, ROCE, J curve possible, and margin improvement possible. Now, we have discussed all what good things that can happen and everything. But every business has a risk. So we all know the infrastructure is ready, but commercialization should happen quickly. Otherwise, there will be depreciation cost, stretched return ratios, and if it does not scale in time, there is a possibility that the promoters will have to raise some funds too for day-to-day operationing and all of those. The delayed commercialization can happen. Margin drag can happen because of that. I have explained you all the thesis, and if that does not work the way we expect it to be, we know that it will have impact on already stretched numbers that you are already seeing on screener. There is a possibility in, so execution risk we have discussed. What would be B2B life cycle risk? So declining realizations for high volume oncology molecules. By the way, remember the molecules that Shivalik Rasayan works, they are very low volume but extremely high margin. Very few can actually create those kind of molecules. Competitive pricing pressures, customer churn. So stickiness is important. If customer move to somebody else, that could be a challenge. Agro headwinds, we all know that agro, there can be regulatory ban, environmental bans, and there could be working capital strain. But remember the strategic note given below. These headwinds can impact their return ratios, but not the quality of business or the thesis. It can delay the things, but very unlikely deny. So very important how we think about things in percentages, in risk and reward. All this is fine, but there are a lot of people who believe in a philosophy of getting rich quickly, talk about opportunity cost, being ruthless of moving from one stock to another and all of that. So there are multiple ways to go to heaven. A value investor can start positioning himself, wait with patience for a bamboo tree to grow and enjoy the fruits. But then there are opportunistic who can actually buy it at an inflection point and make it big. So what are the monitorable, which when seen can actually help understand that, okay, the business is now moving around. So currently the asset turnover ratio is 0.44x. When the commercialization starts for the molecules, and if the thesis plays out, it should move to 0.8x to 1x, and at a peak, the asset turnover should be 1.5x. So you can keep a watch on the next 4, 5, 6 quarters. In my view, Shivalik Rasayan should be looked at FY28 story, which is March 27 to April 28. We are in May 26. So please understand that this is a value investing. This is not something which will move like a magical wand. EBITDA margins, currently it is operating at 14 to 70% EBITDA margin. In the harvesting phase, it should clock 20 to 25% EBITDA margin. Currently, cash flow is negative. Very understandable because all the money is put into capex, building the right molecules and having the right talent, hence negative. But at a harvesting phase, the cash flow should be somewhere around 60 to 70% of the EBITDA. And what we need to see the European approvals, US FDA approvals. So the global generic innovators actually wanted to onboard multi-source and de-risk Indian chemicals. See, in the oncology space and in the pharma space, we all know, and there are multiple businesses that have already been covered in ALD on pharma of what is happening in China plus one and how Indian pharma are finding their foothold in CDMO and all of that. So China plus one is actually happening. Now we will see how Shivalik scales up. Quickly move on to the technical. This is a monthly chart. Please understand that monthly charts are looked with a time frame of multi years. So this is a long monthly chart. And what I could see, the month of March, April, and currently we are in month of May. 2020 is the level where it took support in a month of March, which was a heavy correction, and we all know that. In April, it has moved a little bit. In May, it has moved a little bit. So, last 3 months, it has shown encouraging signs of bottoming out. Also, the wicks at the top are clearly visible where the stock is consistently getting selling pressure from the top. What would be a 0.5 book value for this business? So the current book value is 372. So 0.5 will become 186. Let's round it up to 175 to 180 zone. And currently the stock is at 250 rupees. So I could see that worst case scenario, scale up delays, nothing much happens over next 2-3 quarters. The downside, 0.5 book for a quality debt-free business with a top quality management doing a pivot. But what could be the upside if the thesis plays out? बुरा हो सकता है, but अगर अच्छा हुआ तो. So that is the risk reward. Everybody will have to calculate on their own. I have presented my side of thesis. Now, while before we open for questions and I rest my thesis here, will it or won't it? That is the question. The one who answers it will build their conviction. So to build your conviction, you have to understand whether it will be able to do or it won't be able to do. And when you cross that stage and you reach a stage where you understand that it's not if, but when, that answer will help you build your allocation. So conviction, allocation, understanding the business cycle, value investing. These are the 4 parameters which are in our control. We should think about things that are in our control and rest, leave it to destiny for things to play out. And one more thing, the sentence that is written below, the speed of execution and commercial ramp up is the key catalyst. So everything is in place. As soon as the execution kicks in and commercialization happens, things will start moving. So yeah, Puneet, this is what I had to share. I am pretty much on time.
Yes, yes.
Taken 30 minutes. So yeah, we can, by the way, let me also quickly go into screener and show some of the things, not all. Just give me a sec. Is my screen still visible?
Yes, it is.
Yeah. Let's quickly go so that we can avoid some of the doubts. So Shivalik Rasayan, as you could see here, debt to equity 0.17, share trading at 0.69 book value, 1.22 price to sales. Very important. Let's go to P&L. Expenses. This is the material cost. You can see. Subtract the material cost from 100, and that is the gross margin that they are currently operating on. So that's pretty much understandable for you now that they have already clocked 50% plus gross margin. Another very important point, which you will see, uh, they have any hardly borrowing. Let's go to cash from operating activity and let's see other assets, inventories, fixed asset. Yeah. Can you check the gross block? A 50 crore gross block has gone to 400 crore. That could give you answer of why the return ratios are subdued. No debt, a huge gross block, plant readiness, all the approvals in place. Only thing is execution, commercialization, getting contracts, having sticky customers and supplying. So yeah, so these are some of the things that you could look at, which will help you build. You can also look at current work in progress, which is again almost completed. So yeah, I mean, this is how things are looking like. And by the way, all said and done, the business is still growing each and every year steadily. So yeah, those who wants to wait for execution to kick in, they can refer the monitorable slide, and only when they see the print on screener ratios, then also they can buy. It won't be a delay. Value investors can look to see what they could do. Yeah. So yeah, I stop here now.
Yeah, thanks.
Yeah.
Very effective and simple presentation, Prajot, highlighting the key points.
Right.
Two questions from the question I am seeing actually. So, any specific customers they have got the approvals?
I'm not sure of that. I will tell you the reason. Shivalik Rasayan management does not do any conference call. They do not come on media. There is no presence on social media. Any information that we have is only through their annual report. So this risk is there for Shivalik Rasayan, 400 crore micro cap company, no direct access to management or management interaction. So very, very difficult to understand. Buying levels is your margin of safety. If the thesis plays out, like so, keep this in mind that these are very small businesses, and if the information is available, there will be a lot of smart people who will be able to jump on it. Because it is not there, you have no management access, no way to think of how the operational parameters should be connected to what is happening, and hence the Chinese bamboo tree.
Yeah.
The seed is below the ground, work is ongoing, nothing is visible above the soil. So yeah, I mean, that's how you have to look at this business. Yeah.
Okay. Another question is, we mentioned two molecules, busulfan and peripherin.
Yeah.
Why only these two is the question? Why not few other molecules? Do we see more potential coming out of these molecules itself?
Not more potential. The target addressable market for these two is at least known in numbers.
Okay.
The others, I mean, in my presentation, I was not able to figure out the right numbers for other molecules. So I represented only those where I could see that is the TAM at global market. There could be others also, but I do not. I was not able because see the information is very very less for Shivalik Rasayan. So I was not able to really calculate what could be the TAM. Hence, I have not represented it here. But yeah, I mean, my thesis here is let them execute on what they have built. The car is ready. Only the accelerator is remaining. So if they do that, we will know more. And once things start showing their print in screener, there will be a lot of smarter brains that will do dig and figure out like all those things. But yeah, that is how it is.
Sure.
Yeah.
Last question is on the EPS. I think just with it is standalone numbers what Prajot shows, and I think if you're looking at consolidated, the numbers could be different. So,
Yeah. One thing here, don't mix medicaments. So always look for Shivalik standalone numbers for now, because that will help you how Shivalik is actually doing showing operational improvements. If Shivalik does well, Medicamen will eventually do well. Medicamen is into formulation, have optionalities, and Shivalik is in API. So always study business standalone And once you understand everything and how things go, then go for comprehensive number. Risk of depreciation, obviously, I mean, they have built a plant. What happened with Syngene? They have built a plant in Vishakhapatnam, and a lot of depreciation cost because they were not able to scale the cramps business there, while Newland and all have gone above. So that's why you could, like, the risk is there if commercialization is delayed, the numbers, but you have to factor in how much risk is already factored in the price. Also, one more very important thing, I again said, the stock is currently at 250, point 0.5 book, 175, 180. You will lose 75 rupees and sometime opportunity cost. But if the thesis plays out, what could be the upside? And what could be the risk reward? If 75 rupees is downside, 750 is upside, 1 is to 10 risk reward. But everybody will have to calculate their own. Yeah.
Sure. Okay. So just have a look at a few more comments, and if you can answer that there itself in the comment would be good.
Yes, we'll do that.
Rest of
Yeah.
time, we'll move to the next presentation.
Yes.
Thanks a lot.
Thanks, Puneet. Thanks everyone for your time on Sunday morning, for listening. I appreciate that. Thank you.
Yeah. Okay. Yeah, we'll move to the next presenter, Ankit. Ankit, you are there?
Yeah, I'm here.
Yeah. Okay.
Am I audible?
Yes.
Should I share the screen now?
Yeah.
Is it visible now?
Yeah, visible. We can start.
Yeah. So the stock I'm going to present today is RBZ Jewelers, and it's basically twin engine stock idea. The idea of a twin engine is that when a stock grows or its profit grows, you don't only get the benefit of that growth, you also get the benefit of a valuation, either a PE or the EV beta, whatever it is. Like 10 PE going to 20 PE or 20 PE going to 40 PE. So you get the double engine benefit, right? In that. Basic company overview. RBZ Jewelers was incorporated in 2008, and while it was incorporated in 2008, this business has a third generation legacy now. These promoters have been in business for more than 30 years, but the company itself was incorporated in 2008 by the name of RBZ Jewelers. Before that, they were more like an unorganized business. So right now, both the father and son, Mr. Rajendra Zaveri and Mr. Hari Zaveri, both are running this business. They are the owner operators of this business, and the company is headquartered in Ahmedabad. They are a B2B business. They mainly and they specialize in antique bridal jewelries, mainly the Jadao, Minakari, Polki, and Kundan types of jewelries. They have three main business segments. One is the B2B, where they cater to the global jewelry, the national jewelry retailers, including Titan, Senko, Kalyan, Malabar, etc. Uh, the second business is they have one branded retail store in Ahmedabad by the name of Harit Zaveri. This is the new business for them. The retail store started only a few years ago, around 2021. Okay, earlier, prior to that, they were only doing the B2B and the job work business. The third business, which is the job work segment, is where they take the inventory from the client. Let's say a Titan. The Titan will give them Titan or Malabar will give them the gold, and they will do their jewelry work on that and supply it. So in the job work is what it is, a very asset light work for them, where they don't record the revenues. Whatever the job work charges are there, it directly flows into the EBITDA. So as I said, they have a 30 years plus legacy. The business was started by the current promoter's grandfather 30 years ago. They were an unorganized business, and in 2008 they incorporated RBZ Jewelers. Okay, they have a 2 tons capacity for the B2B and the job work facilities. Uh, okay, and a workforce of 250 plus artisans. Mm. The client list is 190 plus clients. And if you look at the top line plus profit CAGR from last 3 years, it is 28% and 39% respectively. And they are also doing a very good ROE, ROC excess of 15-20%. So we will take one. We will take the take all the three business segments one by one. First coming to the B2B business, which is the wholesale B2B business, where where they buy the gold themselves and do the jewelry work on that, and then supply it to the national retailers. So here they supply to around 72 cities and across 20 states in India, and their major clients are Titan, Malabar, and as well as Senco. On the right hand side, you can see their volumes in kgs what they have done over the last few years, which has been pretty steady because gold price have risen over the last 2 or 3 years. So the same volume is giving them incrementally more revenue. Okay, their specialization, as I mentioned in previous slide, is in antique bridal wear, Jadao, Minakari, Kundan, and Polki designs. So this business has a little bit of seasonality impact on it because because since it is an antique bridal jewelry, it is mostly sold during the wedding season and the festival season only. Okay. The second one is job work business. Job work is the asset light part of their business where the gold is supplied to them by the national retailer. Here the client base is very small compared to the B2B business where they have 190 clients around. Here the client base is only 8 to 10 national retailers where who supply them the gold, and what RBZ does is they do the jewelry work on that, their designs on that, and they give back the gold to the national retailer, and they take the job work charge. So the revenue which you will see here is very small because all the revenue is directly EBITDA only, because they only charge on their designing on their designing fees. The gold is not owned by them, so whatever the revenue is directly flows to the EBITDA or the PBT. And here as well, as you can see, the same volume around this business is very steady. This has not grown very much. Okay, they are doing around 500-600 kgs every year. The third and the most interesting part of this business is which the retail, which is their retail store. This business actually gives them 50% of their EBITDA and their pet, despite being just one single store. Okay, the showroom started around in 2019. Okay, then we had a let's say the COVID year, and so first 2 3 years were not so good. But since then, you can see the revenue in this business has been consistently growing, and they are doing an annual annual run rate of around 400 crores from the jewelry retail store, which 2 or 3 years ago was around only 100 less than 100 crores. In around 2021, it was less than 100 crores. The volume growth is also very good here in this retail business, despite the gold prices increasing. Okay, the gold prices have more than doubled in the last 2 or 3 years. Okay, the size of the showroom is 11,000 square feet. They have recently added one more floor in in this showroom. Okay, and here they sell, the benefit of this retail store is that they sell their own designs, which they supply to the B2B national retailers as well. And along with that, they buy some daily wear jewelry items from outside. And recently what they have done is, in their B2B segment, they have started a pilot project in for the daily wear segment as well, so that they don't have to buy this daily wear segment in the retail store from outside. So in future, that would help enhance their margins. A little snapshot of their revenue growth and their PAT margins and EBITDA margins. As you look from FY22, in FY22, they had 140 crore revenues, and since then the revenues have been consistently growing at around 30, around 25 to 30% year on year. It's been a linear growth almost. Okay, and recently the Q4 results have been out, but when I submitted this presentation, only the 9 months revenue. So I have only recorded the 9 months FY26 revenue. But even if you look at from 2022 to 2025, the revenue have more than tripled. And similarly with PAT has gone. PAT has also gone 3x, around from 14 crores to 39 crores. Margin is a bit cyclical for them. Quarter on quarter, it can be different, because since their main reliance is on the B2B business, and it is the seasonal business, since they are mainly only doing antique bridal jewelry. So usually Q2, Q3 are very heavy for them. Okay, but the addition of of the retail store has added some stability to their margin profile. Last column is the ROC. It has been consistently around 20%, which you will see. Most of the good businesses in the jewelry segment. If you look at the retail, many jewelry retail stores, they are all clocking this kind of ROC numbers. So the numbers for RBZ jewelers are in line with what you will see with the bigger retail stores. Okay, the IPO came in around 2024, and it was a subdued IPO. Not many people were looking at it. Okay, there was a recent credit report which came out, and which looked at the IPO deployments, and they didn't see any deviation from that IPO deployment funds. Okay, they also had a recently credit rating upgrade in March 2026 only. Okay, it was. So looking at one by one, if we separate RBZ now into two main parts, one is the B2B and job work business, the other is the retail business. Okay, the B2B and job work business is their legacy business. Here, what we are seeing is some businesses. RBZ, what RBZ is doing is, until now they were B2B and job work heavy business, and now they are transitioning their business into B2C. So whilst now B2B and job work still remains their core cash engine, they are slowly moving into B2C. If okay. And even in their B2B business, if you look at their gross margins, it is around 20-25%, and which is there is only one listed player in the B2B segment in Indian markets, which is Sky Gold. Sky Gold has a very low gross margins, because what Sky Gold does is mainly they do daily wear, and RBZ is specialized in antique bridal jewelry wear, so where they have exponentially much more margins. And this business is very stable, high cash flow generating business, because it has no marketing expenditure or brand building expenditure, and payment cycles are very small, 10 to 15 days payment cycles are there. So it gives them a very good turnover ratio as well, which leads to high return ratios. Job work, as I told you before, they get the gold via the gold metal loan from their clients. Okay, from the national jewelry clients. And within that business, they what they do is they charge them the making charges, plus they get the benefit from the gold recovery, which while in the making process, which goes to wastage around 2-3%, they get that benefit as well. This is a zero working capital business. Okay, sometimes the customer also gives them the advance to make during the festival seasons. And as it's zero working capital, there is no metal charge to their balance sheet. Okay, all the revenues flow to the EBITDA and the PBIT. And it also, in this job work, what this does is that they have a 2 ton capacity, and since the gold prices in last 2-3 years have risen very much, they are not able to fulfill this capacity in their B2B business alone. So this job work business allows them to utilize more of that capacity, which otherwise would have remained idle. Okay, so as I discussed, now they are transitioning from B2B to B2C. Okay, so around when the IPO came, they had only one retail store, and and the management guidance was never to expand that retail store. They only wanted to have that one retail store, and their focus was on scaling their B2B business. They even talked about 4 to 5x capacity expansion in their B2B business because it was going at a very good pace. But from 2024, what happened was gold prices shot up very quickly from 50,000 to more than 1,10,000, 1,20,000, which we are recently seeing. So what happened was that same capacity, which was 2,000 ton capacity, which was able to give them a potential of 2,000 crore revenue. That same capacity, 1,000 crores of revenue. That same capacity now has the potential to give them more than 2,000 crores of revenue. So expanding capacity in that B2B business doesn't make sense because the same capacity is now able to serve them for 3 to 4 years now with incremental revenues. So now what they have planned is, since the Ahmedabad store is doing really well, so they are now using the cash generated from their B2B business. So they are using that cash to expand their retail footprint in the rest parts, so in the other major cities of Gujarat, including Surat, Rajkot, Vadodara, Gandhinagar. So they want to become a Gujarat centric regional jewelry retailer now. As you look at Thangamile Jewelry or PNG, they are very much focused in their own. Thangamile is in Tamil Nadu. PNG has a regional presence, most of it in Maharashtra. Senko until recently was mainly focused in West Bengal and those regions. So RBZ right now wants to do something similar where they want to make a regional dominant presence in the state of Gujarat. Okay, so since the capacity expansion is not really needed in the B2B, there is no need to build that all that capex, to take the extra debt and do that all that expansion and higher inventory build up. Instead, what they are doing is they are going for the asset light approach where they are leasing some of the stores. In There are two of the stores are finalized. One is in Surat and one is in Rajkot. Okay, so these would be lease stores. They won't own the premises. Okay, and this will require far less capital, and B2C generally would have much more better margins. And if you look at B2C businesses, jewelry businesses in India, there are two things. They have a good base of wealth creation in the Indian markets. If you look at 4 or 5, 6 examples, you know mostly other than something like PC Jewelers, or where there have been some corporate governance issues, most jewelry retailers have given have grown good wealth for their shareholders. Right now, 50% of the revenues comes from their jewelry retail store. Going forward, they are targeting this mix to go to around 80% from the retail business itself, and B2B would remain only around 20 to 30%, which could lead to re-rating in their valuations. So for next year, which is FY27, they are targeting opening of 4 new showrooms. Two of the showrooms are scheduled to launch in the quarter two itself. One is in Surat, one is in Rajkot, and both of these would be flagship stores. Flagship store means ones which more than 10,000 square feet, and the two other showrooms which they will open, one in Gandhinagar and one in the other some other part of Ahmedabad itself. Those two will be smaller format stores around 5,000 square feet, and but all four will start within this year itself. So the reason to start the two flagship stores in Q2 is it's a wedding and festival season, so they want to get footfalls from day one itself. And within the B2B within the B2B segment, their utilization is around 45-50% only right now. They are planning to scale this utilization. The presentation mentioned here is full utilization by 2026. But now, since gold prices have risen, this facility they should have peak utilization around FY28 or FY29 only. So, for 2 to 3 years, they don't need any further capacity to even grow revenues in even in the B2B business. Okay, this slide mentions about the retail store, which is in Ahmedabad. So they have seen exponential revenue growth in this retail store. 24 crores of revenue in FY21. They are now doing an annual run rate of. In fact, if you see the Q4 results have now come out, they have crossed the 400 crore revenue mark from this retail store around. They have clocked around 408 crores in the retail store in FY26, and they are saying that this store itself can do revenues around 500 to 600 crores in a couple of years. And they have a very strong brand resonance in Ahmedabad and in Gujarat market, which you can see from the social media following trend. It's been on a constant rise, and this is basically the idea. They do regular exhibitions in Gujarat. Okay, their social media channel is very active, and number of followers are increasing almost every month. Even now, if you look, they have crossed 2 lakh followers on Instagram. Okay, this slide is a little older, but right now, if you see right now, they have crossed 2 lakh followers. So this follower trend, and the success of this Ahmedabad store is what gives them confidence to launch more stores in Surat and Rajkot and other parts of Gujarat as well. So, as I said in the previous slide, two stores are scheduled to launch in Q2 FY27 itself, in Surat and Rajkot, and both would be flagship stores. Okay, they estimate to do around 200 to 250 crores of combined revenues from both these stores, around 125 to 150 crores from each of the stores. Beyond this, they are targeting two more stores in East Ahmedabad. One would be in Gandhinagar and one would be in Ahmedabad itself. In the recent con call, what they have said is, I have mentioned here FY28, but in the recent con call, what they have said is they would be targeting launch of these two 5,000 square feet stores in Q4 FY27 itself, instead of doing it in FY28. Okay, if you look at the store unit economics, how the new stores work out, as you have seen in the Ahmedabad store as well, it went from 24 crores revenue to 400 crores revenue. So how it works is, for year one they only get one times inventory turns. Okay, and gross margins around 15%, which are stable. Since inventory turns are very low in the first year and there are marketing expenses as well, the EBITDA margins are normally in single digits. Okay, and the ROC is very much break even. By year two, the inventory, as the store sees more footfalls, as the brand gets more recognition, the inventory turns start to go up, and that itself leads to higher EBITDA margins. And year three is normally the maturity year where you start to seeing peak, close to peak revenues from a retail store, and which leads to 13-14% EBITDA margins and 18 to 20% ROCE, which is what their current ROCE is. So if you're looking at RBZ Jewelers right now, as the retail expansion goes out, for the next 2 years, the top line growth could be very well, but the EBITDA margins and the PAT margins could suffer because those stores won't reach a maturity level, and there would be high marketing and brand building expenses in Surat and Rajkot. So I've been following this company for since the IPO time itself, and here is what I have made this management checklist. From listening to them for multiple con calls, and talking to some other investors as well who have invested in them, what I found out is there are some qualities which which gives me confidence to hold on to the stock and to invest more in this stock. For consistently since the IPO, they have a track record of delivering on their guidance. Whatever they have guided, they have usually exceeded that guidance. For example, in FY25 they guided for around 35 crores of PAT, but they went on to achieve around 39 crores of PAT. Likewise, whether it's about the top line or whether it's about the bottom line, they have consistently delivered on that guidance. They're growing at 25-30%, but still they have not diluted any equity or raised significant amount of debt. The promoter shareholding remains high at around 75%, and even for the next 2-3 years, since where they are doing this B2C expansion, they have promised that they won't do any equity dilution in the near future. So whatever growth is coming in future, it will come without any kind of equity dilution. They have a very much focus on capital allocation discipline. They are shunning the B2B expansion, in favor of the asset light retail expansion, which normally gives you better return ratios going forward. There are no there is zero pledge on their holdings. And if you listen to their con calls, the way Harit Zaveri discusses, the goal terms, the volume versus the value growth, there are some companies in some sectors where if you listen to them, you get a complete understanding of the sector as a whole. I believe if you let's say Polycab is an example. If you want to know what is going on in the cables and wire segment, just listen to their management and you will get a rough idea of what's going on. If you listen to Aman Financial, you will get a complete knowledge what's going on in the microfinance sector. Similarly, Haris Zaveri, you know, one is he is very consistent in what he says. Okay, con call after con call. The other is he has a complete grasp of the whole B2B, B2C segments, what is going on in the market, everything. And he's very conservative, okay, in terms of their guidelines, okay, and very transparent also, in saying that since the gold prices have risen, there would be some margin pressure going forward in FY27, due to high marketing expenses as well. So he is keeping the expectation tempered, but at the same time, he has a track record of delivering on his guidance. There was recently a 1.98 crores, around 2 crores of fraud which happened in their retail store, and which was immediately reported to the exchanges. And then later on, the amount was recovered from the insurance, and right now the gold is in custody. Some industry insights. Most of it I have kept it for the last, because this is a well covered sector, and most of us know what is going on in this sector. Uh, just The Indian gems and jewelry market, it is expected to go at around 16% from FY24 base to until FY28. And if you look at the requirement by the segments, bridal wear demand is more than your daily wear or the fashion segment. The west region, where the company operates its retail stores in, accounts for 25% of the jewelry consumption of all India. South region is obviously the most highest. Okay, and this is the gold demand in tons, in basically in kgs. So despite the gold prices rising very much high, the gold demand still is very robust. Is still very robust in India. Okay, this slides talk about how the share of the organized jewelry retailers is growing in India. Around in FY22, their share was only 33%, and right now they are, and until 20 FY28 it is expected to go to 40, around 45%. So this incremental shift is itself what is fueling growth in the organized jewelry retailers. If you look at the reported numbers of all the organized jewelers, the shift from unorganized to organized is helping them very much. And around by FY30, this is expected to go to 50% share. So while the industry itself is going at 15%, organized retailers might go at much higher rate because they are taking share away from the unorganized sector as well. So the summing up the thesis here, uh, if you look at all the jewelry retailers listed in India, unless I won't take the example of PC Jewelers because there was some corporate governance issues there. Rest all major of the jewelry retailers in India have built very good wealth. Titan, Titan, Kalyan, Senko, Thangamayil. Okay, they have all. PNG is recently listed and it might do well as well, but most of it, the base case scenario is very good for us to create wealth in this sector. Starting valuation of RBZ is very low. It's currently trading at around 9 PA only and around 500 crore market cap, which if you look at it, the retail store itself would do more than 500 crores of business 2 years down the line. So rest of the business you're basically, if you even if you assign 1x sales, the rest of the business you're getting for free on itself. Okay, and if you look at the valuation of all the other listed companies, they are all trading at 25-30 PE or even more. And once they scale up this B2B to B2C transition, the valuation multiple could relate. Right now, the market is looking at RBZ as some cheap jewelry manufacturer, third party manufacturer, but the transition is what the transition from being a B2B business to a consumer brand, is what can fuel the valuation rating. The management, as we have discussed earlier, they do what the work they have. They are consistently delivering 25-30% growth. So and basically they have capital allocation discipline as well. One of the reasons this is trading at a low valuation is market cap is very low, less than 500 crores, and it has low liquidity. Right now there is no presence of any big investor, any HNI investor, or any big PMS or anything like that. Let's discuss some risks now. So the biggest risk remains the execution risk. Okay, the successful, whether they can replicate their Ahmedabad retail success model in the other retails as well. But what gives us confidence here is that they are they are doing exhibitions right now in other parts of Gujarat as well, which are from where they are seeing good traction, and their social media follower trend is also on a continuous rise. The other and the biggest risk, in my opinion, is they are carrying very much high inventory, which is which relative to their sales. And when you compare the inventory to sales ratio to other jewelry retailers, it is very high, and it could be one of the reasons that despite having 25-30% growth, it has not been significantly regulated, and their cash flows over the last 4-5 years also have been negative, owing to this high inventory itself. So going forward, this is one metric which we need to see how they are able to churn the same inventory in their other stores, and not and go the top line with by they say the going forward the top line should grow more than their inventory. Okay. Third risk is the hedging mechanism. Since they don't have any hedging mechanism. So if in future the gold prices go down by, let's say, 20-30%, it could they could suffer from inventory losses. But what the management says is they have a cushion of around 15-20% on the current prices of gold. The average price of the inventory which they are holding is around 15-20% less than the current price of gold. The other fourth risk is the whole sectoral risk, which is the if gold prices were to go up even higher from here, there is a possibility that the demand could reduce since higher prices. The demand could reduce, which could impact the entire sector. A little bit valuation exercise here. I have included all the in the top four columns. I have included all the jewelry retailers, and the bottom two columns is the Sky Gold, which is a B2B manufacturer, and last is the RBZ Jewelers, which is right now B2B, but it is transitioning to B2C. So if you look at the ROE column here at the end, RBZ enjoys a very good 15-20% ROE, which is not as good as your Titan or Thangamahira or Kalyan, but it is still much better than Senko, which is another B2B company, and it is better than Sky Gold as well. And with their incremental stores, if those stores go on well, this ROE figure can cross 20% as well in the coming 2 to 3 years. So RBZ, I believe, is very cheaply valued right now, despite being a growing company. They are so let's not mistake it for a deep value company. This is a growing company. This is a growth company which is right now very much mispriced by the markets. So okay, their B2B business is very profitable, which is being ignored, and they have shown the retail success in the Ahmedabad store. Whether they can prove this retail model in the other stores as well is what we need to see. So going around, I think 25 to 30% growth is possible. FY27 might not see a relative bad growth because FY27 would have this large store expenses, marketing expenses. But from FY28 and 29, profits should scale exponentially, and I am expecting around 90 to 100 crores of PAT in FY29. So even if we see a modest re-rating from right now 9-10 PE to 15 PE, the stock price could see a jump of 3x. Right now, the market cap is 1500 crores. If they do 100 crores of PAT, and at 15 P, you will get a 1500 crores of market cap. So I think to lose money in this stock is very much next to impossible. How they are able to scale their retail business, how much success they are able to achieve it, their future, the future valuation multiple will depend on that. So that's it, Puneet bhai, from my side.
Great, Ankit. So I think this company possibly deserves more valuation, as you said, as the people realizes it is going a transformation to B2C. One of the key questions I think people have is on the any past issues in the corporate governance or the person who is running the business is having a good reputation. I think it boils down to that. And I think you have answered most of this, but have a look at some of the
Yes.
questions in the chat. I think they are on the similar lines.
Right now, there have been no corporate governance issues, and as I said, the management has been very consistent in whatever they are saying. Okay, and even when if you listen to their con calls, even when some of the participants in the con call have asked them whether 50-60% growth is not possible or not, they have kept their expectation modest only, and they have delivered on it.
Yeah, correct. Okay, thank you, Ankit. I just checked on the chats for a few more questions to answer from there.
Yeah, I will reply in the chat.
And I think you tried to cover everything from different angles on the company. Thanks. So we'll move to the next presenter. It's our Shekharji. Hi, Shekharji, you are able to hear us?
Yeah, yeah. Can you guys hear me all right?
Yeah, we can hear you.
Okay, perfect. I think the screen share need to be closed before I can share mine, I guess.
Yeah. Ankit, you have to stop sharing, I think. Yes, now I think you should be able to share.
Okay. Perfect. Let's get started. You can see my screen, right?
Yes, we can.
Okay. So we'll get going then. Hello, everyone. Good morning. Thanks, Puneet bhai, for having me here one more time. This feels like Oscar, and I am like the host every second year, which is a
The
good
pleasure
feeling.
is ours.
So I think, obviously this is a wonderful platform where, over multiple weeks, every few months, lots of ideas gets discussed. And then when you start connecting the dots, you will be able to identify some really good ideas that can make money for us, right? And there are lots of individual companies that are covered. And hence today, what I'm trying to do is, instead of talking about one specific company in detail, I'm kind of focusing on one mental model. And then go through 2-3 examples, right? So not in detail, obviously. So they'll be covered at a higher level because of the limited time that we have. But if there are any questions that we couldn't answer during the window, then obviously we can always follow up offline or even on Twitter, right? So with that caveat, let's continue. Quick introduction about me. I think probably many of you might be familiar with Research Reports Telegram group, which is where you get to see all the brokerage reports available. And then on the left side, you find my Twitter handle, Learning11. In addition to that, we also have a community in Hyderabad. I am from Hyderabad. A community in Hyderabad, what we call Hyderabad Investing Enthusiasts. So we try to get to meet people offline and build that network, bring in the awareness, and of course, obviously talk about ideas, etc., a couple of times a year. And Puneet Bhai has been one of our presenters many a times. So that's brief. And then a quick disclaimer before we jump into some of these conversations. I am not a SEBI registered RA. Whatever the discussions that we do here today, these are for information educational purposes. And if you happen to like any of the points that we are discussing, please do your own due diligence and deep dive and take some financial advisor's advice before you get into spending money on it, right? Because whenever we buy an idea from somebody else's conviction, then we generally lose money. So one thing I would like all of you to do, after the sessions is run a simple query in Screener. The query that you see on the screen is the one that I've run. Essentially we are trying to list down the companies where the PAT is between 100 to 350 crores, and they have a 5-year median sales growth of at least 15%, right? Because if the companies, all the other parameters are great, but the sales growth is not there, then it's waste of time, right? So the growth itself is the paramount, and post which we will look at the valuations or the margins or cash flows, etc., etc. And hence a pretty simple query. This will give you 242 names to be precise. And I can say it with a bit of guarantee that some of the multi-baggers that we're going to see over the next 4-5 years will come from this list. And this is an exercise that you could do going to the back testing and all. You will see a lot of reliable data. It doesn't mean all of them, obviously not all of them, only a few of them, but some of the multi-baggers are hiding in that list. So this mental model comes from a gentleman named Amit Jeswani. Many of you might know him. Stallion at PMS he has. So he spoke about this at one of the conferences a few years ago, and then it kind of stuck with me and some of my friends. Right. So whenever a company is transitioning the journey from 100 crores to 1,000 crores sort of a opportunity drive, it creates tremendous amount of wealth. And there are a number of examples. So I will not bore you with too many examples. A couple of examples that I've taken, which most of us are familiar with. For example, MCX, which was sitting at slightly below 150 crores PAT, 4 years ago. Today it is sitting at 1,300 crores PAT, and naturally that resulted into a 10x sort of a returns, right? Of course, the FY24 where you see 83 crores, that's more of an aberration. It didn't really fall. It was more of the technology vendor headache and the one-time payment they had to make and all that. So in fact, some of those corporate issues kind of kept the stock price down. And once those things are sorted, once market realized that this is a platform business with extraordinary operating leverage opportunity, then stock went on to a different orbit. And of course, thanks to the commodity, commodity price fluctuations over the last year and a half, it became a huge tailwinds. So in a practical sense, the PAT wouldn't have grown this faster. I mean, very rarely you will find, 100 crores PAT going to 1,300 crores in 4-5 years. That usually doesn't happen. But technology companies are the exceptions there, right? Like right now, if you want to correlate the AI companies, so to say, right? Because they have they're platform driven, the operating leverage is unlimited. because you are not constrained by the assets or you are not constrained by the shop floor. But if you take another example, Laurus Labs, again, Laurus Labs had its own cycle. Many of you might have been invested at that time also. Just before COVID it started, and then COVID accelerated, and then by FY22, the PAT went up 10 times, and so did the stock price, right? Again, a tremendous amount of wealth many people made in it. And then the downside started. Many people started calling it bogus labs and all the fancy names. Before Laurus rediscovered itself into a CDMO world instead of the generic. And the current growth that they are seeing in the PAT is coming out of the CDMO space, right? So again, Laurus is now in its second cycle of transitioning from 100 crores to 1000 crores sort of a journey, and already kind of became 2.5, 3x. And I think, in my opinion, the story is going to be there for another 3-4 years at least, right? So it's still a long story. And I'm pretty sure we can find many examples like this that have transitioned from 100 crores to 1000 crores and thereby creating the wealth, right? That's the mental model. So that was the reason I asked you to run that query once the sessions are done, and then see what names are popping up and if any of those names have the potential to continue to grow. Why? Because 80% of those companies will fall flat. Like how I said, 4 or 5 years from now, some of the 242 will be the multi-baggers. Exactly in the same way, 80% of the names will do nothing. And some of them might actually degrow as well, right? Because businesses are not as easy as generating stock returns. But if we are able to catch even 1 or 2 good ideas at reasonably right time, I mean, that will make your portfolio smile a lot, right? So that's one mental model. The second mental model is, I'm unable to see the top line. Let me hide my controls. Okay. Yeah, so the second mental model is about how a company is transforming itself in its capabilities. Again, the number one example could be Laurus itself, since we just talked about it. So Laurus transformed itself from being a generic ARV into a CDMO, and then, peptides and ADCs, fermentation, so on and so forth. And likewise, there are a number of examples. PI Industries, who used to do polymers in the past, and then they focused, they dumped it, then they focused on the, the specialty IP-driven agrochemicals. And then Navin Fluorine, another beautiful example, from selling the gases to a CDMO revenues of 800 crores in the next 1 year or 1.5 year. It's a huge transformation. And then same is the case with Bharat Forge, or same is the case with even Tube Investments, for example, Murugappa Group company, who's from selling the bicycles to, a different platform altogether. So there are hundreds of examples. I mean, that's a reality. And if you are able to find an opportunity where there is a company that is transforming itself with the new capabilities, new capacities, which are high margin, high value added, and in that journey you get to do this, 200 crore to 1000 crore or 300 crore to 800 crore sort of a journey, then you have a much better certainty of making money, right? For example, MCX is not about transformation or capabilities. And MCX is about, I have a platform, I scaled up my platform, I have a business tailwinds, and I made more money, right? Whereas Laurus or Navin Fluorine, these are the transformation driven along with the scale, and hence they have reached where they have reached, right? So the sweet spot will be looking at a company that is transforming itself and has the potential to grow its PAT, right, over 2-3x over the next few years. So that's the precise topic for the next 25-30 minutes. And my idea is to quickly walk you through with 2-3 live case studies, and then see what they can do over the next few years. The first one is Sigma Advanced. Many of you would have heard this name. This name has been buzzing, for the last few months, ever since the Nasmith Group acquisition and then the Rolls-Royce 3,800 crore contract. Many people started noticing, and it's been on circuits, etc., etc. But in a simple, pragmatic way, this company used to be just a defense electronics company just about 2 years ago. And in the last 2 years, they have acquired 1/3 stake in an anti-drone company called Indrajal. Then they have acquired 100% stake in aerospace company called Nasmith Group. And then they have acquired a majority stake in a defense broker called AS Strategic. And then there are more conversations happening, right? So we will touch upon this in a minute. And then likewise, Sansera Engineering, again, well-known, well-popular. And some of you might be wondering, hey, Shekhar, what is wrong with you? Why are you telling us this idea on a Sunday morning? We'll see in a couple of minutes. Again, a predominantly auto ancillary company transition itself into a defense aerospace semiconductor, what they call ADS. And the reason I'm specifically talking about this today is because of some of the fresh updates that I get to hear on the con call, because ADS story was known to the market for a year, and which is why stock price had run from that 1500 to 2300, 2400, right? And then of course, more run after the results. And then another live case study is OBSC perfection. I think this was presented in this forum probably a year and a half ago. It has done quite well since then. So congratulations to the original presenter who did a wonderful job identifying this company when not many were looking at it. Again, the latest con call had given some of the very deep insights, which made me believe that this is exactly in the middle of a transformation story, right? Which is our mental model for today. And hence I'm including that here one more time. And then the last but not the least, there is a company called PVP Ventures. If any one of you are tracking this, you might start cursing me right now. But if not, you can Google about PVP Ventures and its past legal issues. Then you will start cursing me. One way or the other, you can curse me. Okay. So the example in this case is just not the capability transformation. This is the corporate transformation itself. The company is shedding its past weight and marching towards a new story, right? So we'll spend a few minutes on this as well. Like I said, I will not do a deep dive into each one because then that will be a 3-hour presentation. But I'll touch upon the key triggers that I believe are going to do well over the next 3-4 years, and then the rest we can see in the Q&A. So Sigma Advanced, like I was saying earlier, the original Sigma was a defense electronics company. Oops, power gone. Hopefully you can still see me and hear me. Defense electronics company. They used to supply components for radar systems or the electronic components, or even the components for the black box in the aircraft. This kind of a story, right? A small company in the same space where you have Astra Microwave or Apollo Micro exist, right? So this is no way can be comparable to those names. They are in a different league altogether. But I'm just letting you know for your understanding that this is in that similar line, much smaller, much smaller. But what is quite interestingly happening is while it is stuck in that smaller league for last few years, they've started making some good moves now. For example, this year alone, in the last 3-4 months alone, they have won 2 contracts worth of 200 plus crores. Each contract 100 crores. One contract came from defense PSUs, and the second contract, which was announced just last week, it came from North America, which is to supply fuses for the 150 shells, right? Which is a pretty not a complex component, but pretty niche, considering the fact that they're getting it from North America, right? So they are essentially moving up. Then the next one is Indrajal. This was the anti-drone company I was talking about, a 38% stake that they have. This is again small company right now. Their revenues are less than 100 crores per annum, but they are in the very niche space. In fact, there is a video that is in circulation over the last day and a half. I don't know if it was NDTV or CNBC. Someone did a small interview, not interview, rather they made a recording of a new Jeep with all the anti-drone capabilities in it. So maybe we can circulate that video post the session. But essentially, the Indrajal got its name and fame from the fact that it was deployed at the Western Command during Op Sindoor. If you guys remember Op Sindoor, it was more of a drone warfare, right? Pakistan was flying and all these cheap drones at us, and then we had to send missiles to block it, which is like a very poor ROI in that sense. So, which is where some of these companies have stood up, Indrajal or IdeaForge, Zen Technology. Some of these companies have actually done well during that time, helping the Indian Army in putting these technologies in display in the real time. So in that way, Indrajal now has a battlefield experiences, right? It's one thing to have a software run in the lab 24/7. It is entirely a different ball game when you have to do it in the real time in the real war scenario. So that those experiences can make you really, really good. It will help you understand what else you need to build for the future, right? So that's Indrajal. And again, Sigma stake is only 38%. But the reason I'm excited about Indrajal is just not about the warfare. I mean, obviously, the last few years, thanks to Russia, Ukraine drone warfare, or Iran and Israel drone warfare, we've been hearing about drones and anti-drones quite a bit. But I am more excited about this anti-drone story from the commercial utility point of view. Today, if you look at anti-drones are deployed at all the key institutions, right? For example, a nuclear plant or atomic energy plant or a defense, areas, etc., etc. But what I believe over the next 4 or 5 years we will see is you will have an anti-drone infrastructure set up at a school, at a residential gated community, at a temple, at a hospital, at a mall. We'll find plenty of this. Why I believe? Because drones will become like the way mobiles today are. Literally everybody can afford, everybody can play around with it, and it's quite accessible. I think that's where we will get to be when it comes to drones. So when everybody has access to drones and they keep flying every now and then, you will run into all this security and privacy and this kind of issues, and thereby all the public spaces, the commercial spaces will be forced to have an anti-drone infrastructure. So that is the reality is what I believe, because I wouldn't want a drone to come knocking my bathroom window, right? We need protection, we need safety. So those kind of things will happen. And hence I believe the TAM is not even can be calculated right now. I think a lot of technology and trends will emerge in the anti-drone space. And I think Indrajal, with its early inroads into it, should have a good opportunity, is my opinion. But the bigger story about Sigma is Nasmith Group, because that's where the bulk of the revenues come from. Their annual run rate is about 730, 740 crores. They acquired it for about 230, 220 crores. And if you are wondering, oh wow, 700 crores worth of a company for 200 crores, that is so cheap. How could Sigma pull off a string like that? No. In fact, Nasmith was on the sale, on the block for some time. A couple of other companies have evaluated, but Sigma leaped in and then paid whatever they had to pay and bring it on board. Why? Because it is a distressed asset in some senses. It's based out of UK. If you actually tracked what's happening with the UK businesses and even Europe businesses for that matter over the last 5-7 years, many of the businesses are sold into, many of them, because of the high energy prices, because of the shortage of the labor, because of the lack of technical advancements, because the industrial revolution in UK, Europe stopped right a while back. So they kind of left behind, and with the increase in the energy prices and all, and the wages, it became a nightmare. Pressure Instruments, for example, is a classic example. Some of you would have heard about it, how they struggled with their European plants. Same case with most of the companies. Rishabh was smart enough to play a right game and then bring it under control. Still not fully under control, but at least they're doing better because of the other subsidiaries that they have. Whereas if you were a pure Europe or a UK-based company, then you don't have much of a choice, right? So that's what is happening with most of the companies. So Indian companies started acquiring some of these in the recent times, but Chinese firms have been acquiring many of these assets for dirt cheap rates over the last few years, right? I think Belra has acquired Cheston Hall, another aerospace ancillary company. So this trend is now going, and I think we will see lot more. I'll be surprised if we don't see this trend a lot more over the next 3-4 years. Like Indian companies going and acquiring many of the European assets. So this was acquired in that sense. So Sigma has to spend a good amount of money on it now, because one, they will have to upgrade the machinery and capacities, and second, they are shifting a lot of work to India, which is where obviously margins will play out. It's been a predominantly UK company. They had a small space in Bangalore. But what Sigma is now doing is they're setting up a leased facility in Sri City, and a good more than 1/3 of the work will happen from Sri City over the next couple of years, right? And that's the game here essentially. That while the group will continue to grow on the top line, their profitability will become much brighter now over the next couple of years. That's the main story. Plus, of course, this company gets more than half of its revenues from Rolls-Royce. I think I got the spelling wrong there. So this is a risk as well as an opportunity here. It's a risk because, if the Rolls-Royce says, thank you, goodbye, then the whole thesis around a Nasmith and Sigma dies down. But obviously my assumption is Rolls-Royce cannot say it. Why? Because Nasmith is supplying very critical engine components, right? And for those of you who are already aware, you are good there. But for the benefit of those who probably don't understand the role of Rolls-Royce, in engines, when you look at, right, aerospace aircraft engines, you have a narrow body and then you have a wide body. You have like the typical Indigo flights that we fly, the 220, 320 series, they are narrow body. And then the bigger ones, you see the international flights with the private cabins and business class, first class, the 787s or 380s, whatever. Those are the wide body. So the wide body engines have to be really, really top notch because the amount of weight you are lifting into the air and pushing is huge, right? So that's where Rolls-Royce is. Rolls-Royce doesn't make not much into the narrow body side. They are more into the heavy body side. And they're the market leaders there. So now imagine the wide body, which are very expensive engines, the number one player, you are supplying to them the key engine component. So what else can be a better thesis than that? Especially when Rolls-Royce had a multi-year order book pending there. I mean, right now the whole scenario is the aircraft manufacturing is skewed for 12, 13, 14 years kind of a backlog. And then engines are also in the same way. You look at any other company, not only Rolls-Royce, you look at Safran, you look at CFM, any other 4 or 5 OEMs, GE, etc. Everybody has huge order backlog. That's a good sign for the companies which are doing business with them, right? So now it all left to Sigma, how they can scale this business and increase their wallet share from Rolls-Royce. And then they have a fourth one, like I was saying, defense broker. If you watch Hollywood movies frequently, one common role you will find in the Hollywood movies is defense brokers, right? Typically, the evil people who do the coups and who change the governments and all that, right? Of course, let's hope AS Strategic is not that kind of a evil player. But this is of that sort. These are the defense brokers. They don't have any manufacturing plant themselves. What they do, there are defense firms in Europe who win the orders from, for example, defense companies or from armed forces, etc., etc. And then they look for some cheap, low-cost manufacturing partners who can manufacture them exactly same quality at a much lower price, just like IT offshoring that has happened, in the last 20 or 30 years. Similar thing. But here the challenge, of course, is that you can't manufacture those components with anybody. You can't, because you have to have some certifications and qualifications and all of that. And that's where AS strategy comes into the picture. So what these guys do, they talk to these defense customers in the Europe and they'll say, hey, look, if this is the component A that need to be manufactured, here are my 4 offshore players who can do it at a cheaper price. And all the 4 of them are certified, right? They have a license, they have a audit done, so on and so forth. And that is good for them. So that's the kind of a business that this company has been doing. So what Sigma had done, Sigma has acquired 51% stake in this company. And what it means is the order book, whatever AS Strategic has, Sigma has the right to reject it first, right? Sigma can now choose out of this 300 crores order book, which of those components I can manufacture myself with the core capabilities that I have. And wherever I don't have the capability, then those will be handed over to somebody else, whoever, right? So and hence that can create more opportunities for Sigma going forward. So these are the short, small set about incurred estimates for Sigma. They are expected to cross some 1,700 crores revenue for FY28. And you give whatever the multiples you give, it doesn't look cheap right now. So the reason we are talking about this is not because it is cheap today, but because it's a company that could have a very bright future over the next 3-4 years. They are talking about fundraise, they are talking about more acquisitions. So there is a lot more that could happen here. And what I leave you, Sigma, with is that if there are any corrections that will happen, this could be a name to keep an eye on. Right, like the way one acquisition of an order book drove the price to 50, 60, 70%. Another acquisition or two tomorrow, another 1 or 2 orders announcements tomorrow, again, story might be back on, right? So any correction in my view is an opportunity. Moving to the next one, Sansera Engineering. Again, everybody knows, I don't have to beat the story here, but in one simple chart, essentially what is happening is a auto ICE heavy delivery revenues, which used to be more than 80% just about 5 years ago. They have come down to 70% now, and they're expected to hit 60% over the next few years. How soon? I have no idea. Me being a conservative guy, I have estimated that by FY30 it may happen. But in my opinion, if I need to be a little more optimistic, could happen well before. right? And what it means and why this caught my attention while everybody knows about Sansera already is for three simple points. One, management had categorically called out that with the order book and with the kind of relationships that are being built, they do have a visibility of getting to be that 8,000 crores annual run rate company soon, right? In a few years. They didn't give a specific year, but few years. Typically, when we say few years, it's typically 3 to 4 years. So today the revenue is 3,500 crores and they're talking about more than double for a company of this size. When a management that is proven, that has great capital allocation history, that has excellent execution history, is giving you that sort of a guidance, you better take it with, being seriously, right? And then, of course, towards that, they are doing some of the nice JVs and winning a lot of new customers, so on and so forth. Now, the semiconductor, which is the other space, which used to be a pretty small component in their ADS until 1 year ago, suddenly is seeing huge volume surge. Right now, majority, they have one large customer, Lam Research. They're doing a lot of work for them, which was kind of unexpected. I mean, nobody thought the amount of work that they're doing with Lam Research that they would do today about a year back. No one thought about it. They're doing it beautifully well. And they are also in discussion with another large player. That's all Sansera had said. But the chatter and the rumor mill in the market is it could be ASML. Whether it is ASML or could be some other name doesn't matter because there are only handful number of semiconductor players in the world anyway. So no matter which other player they're working with, if they're able to crack the contract, it will be a huge advantage. And then of course, aerospace, they've been into aerospace before. They've been supplying parts to Boeing and some of the other players for some time. And within those parts, they have migrated from simpler lighting and cargo parts to...
Recall.
Sorry?
Hello?
Hello? Okay.
No, you go ahead, Shekhar.
So from supplying the simple parts to, supporting landing gear and some of that area, which itself is a complex, right? If that's not complex enough, the update that they have given in the recent con call is they are now developing components in the engine discs, basically bladed discs. These are the discs that you could see. So discs are essentially, come in the rotation place. What you see on the screen, those are the various blisks. The full form is blade disc. This is a very complicated area. It is a complicated area because, for example, oops, there is a lighting thing. Okay. So what you see here on the screen, wherever you see my mouse pointer, the fan blisk or compressor blisk. For example, these components, they are not manufactured as 20 different items and they are bolted into each other. No, it has to be a single piece of work. So it's like an art. That's how critical they are. So there are very few people who can do this. For example, Azad Engineering is in this space, which is why the valuations it gets what it gets. So now imagine Sansera being able to produce a component like this and getting it through with a top-notch engine OEM. Right? So they're working with an engine OEM. I don't know if the OEM is Rolls-Royce or CFM or Safran. I have no idea. But whoever is, it doesn't matter because, right, there are only, again, 4 or 5 OEMs. So they are working with one of the OEM. It will go through the first article inspection over the next, few months or whatever. If it is through, then there's a huge TAM. Why? Because right now, one of the choke point for the aircraft backlog is engine supply. Some of the engine players, for example, Safran is struggling with supplying the engines. Rolls-Royce has a huge backlog. So is the case with CFM. So there's a huge backlog. So which is why these engine OEMs are looking for more and more precision engineering players, which is why the heading at the top you see precision engineering is a new premium. There are very few players who can actually do finest amount of job. Doing the precision engineering for an auto or a trains is one thing. Doing the precision engineering for aircraft engine components is entirely a different thing. So if Sansera is able to establish that sort of a brand, then it's a matter of time their aerospace will explode with orders. Right? So with all this background, I encourage you to go through the con call once because sometimes it helps to hear from the management directly than some XYZ guy telling you. And then you will see the confidence that you will have. Because I was never going to talk about a Sansera company at any presentation, never. Right? For me, I thought it was always a 15-20% sort of a CAGR company. But this con call made me change my own perspective that we are witnessing something really big into the future. But still, I went with the conservative approach. I'm assuming a 3 to 4 year window, 8,000 crores, which is what management had said. This is not even my assumption, matter of fact. And then you take a conservative 7x price to sales, because precision engineering companies can be, considered or rated with the price to sales multiple. Then it is still talking about a good upside, very good upside for a company which is very stable. See, if I were to put a 10% allocation in a very, non-visible company, SME company, I need to think twice, thrice, 4 times, right? For example, Sigma Advanced, I may not be able to put huge amount of money because I don't know if they can execute Nasmith Group well or not. Whereas Sansera, it's a proven track record, capable management, competent management, and hence with a higher allocation, even if it doubles, it's a good thing for your portfolio. That's the way I'm seeing this as an example. The rest I'll leave it to you. I'll quickly running on. The next one is OBSC perfection. I don't know how many of you were present in the last session when it was presented for the OBS. So I'll quickly cover a few minutes here. Originally, just like Sansera, they are an auto ancillary company doing some machining components. And then they gradually expanded their ability from machining into casting to cold forging, hot forging, stamping. These are all the various ways of how you bend the metal, right? End of that, these are all various processes and techniques to bend the metal and make the metal dance to your tunes. That is what this engineering is all about. So OBSC, for its own small size, it is able to actually make it happen. They are consistently growing their capabilities over the last couple of years. And that's not good enough. They are using the same technology to expand into defense and marine, where it's more precision there, and they're doing well. But one latest update from the last con call is that now they have two components that they're working on, which have a large volumes. For example, casings. Casings is, as you know, when you keep firing, the cases come out. So that have a huge volumes, right? The cost might be low, but volumes will be extremely high. And then the second component or product that they're working on is ignition driver. Whenever you see a artillery shell, for example, 150 artillery shell that Russia, Ukraine keep using, firing at each other, or Iran, Israel, whatever. So those shells, whenever you are firing, it need to have 4 parts of ignition drivers. And once the firing has happened, it's gone. Now you have to put 4 more to fire the next one. So that's how things work. Again, a high volume game. And unfortunately, with all the conflicts around the globe, it will continue to be high demand. Right now, the demand for 155 shells is extremely high, extremely high. There are not enough, matter of fact. So naturally, whoever is manufacturing those 150 shots, then they need to have the ignition drivers also. So that's the game that OBSC is trying to play, a high volume game, high volume game. And then, of course, they also made another announcement that they have supplied about 4,000 aluminum parts for humanoid robots. For obviously one of the world's topmost player, assumedly Tesla, right? Now I think that went well. Now they are waiting on for 2 large orders coming from the Indian tier 1 player. So they don't supply to the main guy directly. They supply to tier 1 guy. Tier 1 guy does the assembly and send it to the main guy. So they are expecting 2 large orders from tier 1 player in India. And then some of their medical implants are already in execution. And if these are all not good enough news, the other update that they have given is they are probably a few months away from getting the aerospace certification, which is a mandatory one before you can produce any components. So that is a big statement. If they're able to crack this, and they're already saying that they have started registrations with some of the prospective customers, it doesn't mean they'll get the money immediately. Let's not be in hunky-dory hopes here. It will take some time. It's not an easy job to crack aerospace things and get the orders. It will take its own time, but they're on the right track. The rumor mill here is that one of their Indian tier 1 supplier can help them do some work for Tesla. That is a rumor again. Not Tesla, sorry, SpaceX. Again, it's a rumor. Who knows? Maybe happening, may not be happening. So these are all the exciting things which are happening. They have a very strong relationship with the Tenneco and Tata Autocomp. They were even talking about 5-axis machining capabilities, which is pretty neat and pretty niche, right? Not everybody can master that. Now, can these guys master it or not? I have no idea. But my point here is that a small guy is expanding capabilities and capacities and bringing in more high-end customers on board, which means they're doing something right. Yeah, so that's the thesis. So a simple growth numbers, according to the management, what they have given is 40-45% growth, still shows decent upside for FY27. But if they're able to, start supplying more and more in the defense and, humanoid robots and the aerospace thing is cracked, then you could be talking about a very huge non-linear upside, but I'm not going there. I don't want to give you false hopes, but that's the possibility. Could this have the potential to be a 10x story in 5 years? Absolutely, yes. Can they make it or not is what we have to wait and see over the next 1.5 years, right? That is the tracking we need to do. So if I were one of you, whether I own this today or not, whether I buy this today or not, I should definitely track this company because these guys are doing something right. So with that, the final slide, I don't know if I'm actually overrunning time here. The final slide, this company is what we call PVP Ventures, what I was said on the slide 1. So they have recently changed their name. That is the name that you see on the screen. Now this is a absolute zero, absolute disaster, or a super mega star. One of these two will happen. This will not be a 1x, 2x story. Either things don't work out from the current price, it may fall 50% and become a penny stock. Or if things work out the way these guys are talking about, which I'll explain to you in a couple of minutes, this could be a 10, 20, 30, 40 bagger. Could be unlimited, right? But the caveat here is whatever the money, if I want to put something into this, I should be willing to lose 100% of that capital, 100% of it. And hence I shouldn't play this kind of a game with a 5, 10, 15% allocation. I should never. This should be 1% or below 1%. So with that caveat, what is happening is if you Google this company or if you Google a gentleman named Potluri Varaprasad, PVP, if you just Google PVP cases, you will find plenty of it. This guy was into real estate, media. He was owning some, TV channels. He was doing a lot of real estate in Hyderabad and Chennai. And he was in the entertainment world. He contested for member of parliament, all of that, right? So he was a pretty high-flying person about 15, 20 years ago. And then he got into the politics, went onto the wrong side, got mixed up with some people who did pretty nasty things. And then he ended up, seeing all his properties attached to the ED cases and all of that. After a 10, 15-year court legal battles, finally he cleared his name because he was at the, I wouldn't say there was no smoke or whatever, maybe there was. But if he's come out of the court cases where some of the other folks couldn't, right? The folks that he's associated with, they're still stuck in the ED cases, but he came out. So which basically gives me at least a slight confidence that probably he was not as bad as what he was projected to be. So now he is out. His properties are completely off. I think the one final property was still under ED attachment, which High Court already cleared it. It's a matter of documentation and clearing it through. This was about 6 months backstory. So by this time, that also would have been cleared. So no legal issues anymore. All the properties he got back. And what he did is he monetized all those properties. He monetized the properties that he had in Chennai and Hyderabad to some real estate firms, and he's getting regular cash flows. Every year on an average, he'll get about 250, 300 crores. So he is using that money to build a new business, which is on the healthcare side. So that's the overall plan. Basically, he's trying to do 4 lines. One is the senior care, for which they are scouting some acquisitions in UK and Middle East. So could happen anytime. Other one, they are doing the kidney care, the renal care. For example, Nephroflux is in the renal care area, right? They have acquired a dialysis kind of a lab, the 7Med. And then they have also building some diagnostic centers, Medilabs. And then they also have some oncology care, right? So these are the 4 lines: oncology care, specialized diagnostics, renal care, and senior care. Why senior care in UK and Middle East and Europe? Because it is pretty expensive there, and there is a government funds. For example, in UK, government gives money to the companies for running the senior care because of the social security and all the privileges there, right? And of course, going forward with the growing world population, this will be a focused area. Now, can these guys grow these companies well or not? I have no idea. The senior care, they have not made any acquisition announcement yet. But in the other 3, they have acquired few companies. Now their plan is to grow them, scale them up in the tier 2, tier 3 cities over the next couple of years, for which they have overhauled the entire board and the leadership team. Just in the last week and a half, new announcements have come. The name is changed. There's a new COO, Dr. Neeraja brought in, and then there's a new CFO. And then they are now setting up an international holding company that can hold companies in Middle East and UK. So which is basically showing the seriousness that they are going to probably go through a few acquisitions in the near future. And then when you look at the board, it has pretty good people now. I mean, the old board, if you look at, they were more like relatives, friends sort of a story. Now you have a more professional board. So Saloni, she is solid experience in PwC and KPMG. She worked on many mergers and acquisitions, which kind of tells me that M&A is going to happen here. And then Dr. Ellen Vihan, again connected to UK Ireland, FRCS fellow. So again, the story about the healthcare side. And then Srivasan, someone who has a very solid stint at McKinsey. McKinsey is supposed to be one of the top names when it comes to this kind of global place, right? And again, bulk of his experiences come in the UK and Europe side, which again shows the fact that these guys have formed this leadership team and the board with the intent of acquisitions, which should be happening at some stage. And on the chart, if you see, there are volumes which went out sometime in September last year. That's because that's when the annual report that came out from this company with lots of additional insights that triggered a lot of interest. And of course, the people, friends, etc., they would have also bought it. And when you see the last 3-4 months, huge amount of accumulation happening. I mean, you can say accumulation or you can say distribution, but I wouldn't think it's distribution because the stock price went nowhere, right? The stock price is still there only. So if the stock price went up 4-5x, and then we can consider that to be distribution. But here in this case, it is still there. So I personally think it is accumulation. So again, like I said, just to conclude, this could be a zero story. Nothing may happen if they don't know how to execute, how to scale up. But if this team that you see on the screen, if they're able to execute this well over the next 3-4 years, this could be a story to remember for a long, long time. So let me pause and give it back to Puneet Bhai.
Yeah, amazing, Shekhar bhai. 3 solid companies, basically 2 solid and 1 maybe high risk, high reward kind of a company in this case. Great. So I think any questions, guys, for Shekhar, you can go and ask. You can unmute yourself and ask directly.
Either I've explained so beautifully or it was so dumb that nobody understood anything.
No, it was excellent business. One of the questions is from senior care business, basically in the PVP. Now, this business, overall, senior care is a potential field, but none of the businesses are making money out of it. For example, Max India is also into this, but they're not making much money. So, how much potential you see from that segment?
Yeah. So senior care, their focus is more on UK side here. They're not focused much in India. Of course, while they said they will also try to do something in India, but the primary focus right now, whatever we have heard, is they are actively looking for acquisition in UK, because in UK it's a money making machine. It's a cash flow machine, because the funds come from the government. It's about you running the senior care very efficiently, so that you keep getting the cash flows. So that sort of opportunity in UK. In fact, just to connect the dots, there was this Lasico, right? High-flying company a couple of years ago, and now nobody talks about. So those guys at one point in time, when they ran out of the business ideas within the Lasico core business, they were trying to recruit nurses in India and then process the visas and get the work permissions to UK, because there was so much demand in UK for the senior care at that time. I mean, it is still there. So that's the example. So there is a huge demand. It's a matter of somebody being able to set up an efficient shop and run it well.
Okay. Another one is for your first company, Sigma Advanced. So most of the artery shells and other things are getting a little bit commoditized, right? A lot of companies are getting those kind of orders. At least I know 4 to 5 which are getting millions of orders for the shells and other things. So this is also filling the shells or just the shells outside, empty shells basically?
No. So these guys are not doing shells. They're doing fuses. The order that they got, the recent order, nothing to do with the shell. Shell is more on the Balu Forge, Tirupati Forge, Sunita tools, right? Those companies. These guys are giving fuses for it.
Fuses, okay.
But again, like I said, it's also not a complex component, a regular component only. I think the difference here is that you are talking about a company whose revenues were just about 100 crores for last 3-4 years. He is now getting 100 crores worth of orders simultaneously. So that's the story, that while it is still a commoditized work, their scale is growing up.
Yeah. And one last question is on the Sansera. If revenue from the ADS thing can increase much faster than expected. Is
It
there a
will. In my view,
surprising?
it is. In my view, it is. I think management was still conservative. They are still saying, hey, our goal is to hit 20% in ADS and 20% in non-ICE. I believe ADS will grow much, much faster if two if conditions. One, if the semiconductor, the second large player also, if they're able to crack, then, with two large semiconductor players with the kind of demand that is skyrocketing, sky is the limit. And then second, that the BLISCs, the blade integrated discs, if they're able to crack that FAA through, then not only the business will grow at a much faster rate because there is so much demand in the engine space, but the re-rating will happen again. So the re-rating in Sansera already happened. It was traded around 30-35 PE. It now became 50-55 PE. And I will not be surprised if they break that barrier and get into business. It will be re-rated again to much higher level, like the way Azad is, right? I mean, look at Azad's story. It could be a mini Azad in that sense.
Yeah. Okay. I think that's all from the questions point of view.
That's all. Then, Purit Bhai, I'm handing it over back to you. Thank you so much
Yeah,
for having me here.
thanks for giving the time to us, Secretary. Thank you. Yeah, so we'll move to the next presenter, Nikhil. Nikhil, you can check if you have the permission to share. I've given it to you.
Hi everyone, can you hear me?
Yes, we can hear, and your presentation is visible as well.
Yeah, thank you so much. So, hi everyone, this is my first time, so best of luck to me and to you guys also to hear me out. The company that I would want to present is Panacea Biotech. So, as a professional, I work as a PM in a quite a fintech company, and you can, as an investor also, you can find me on LinkedIn or on Twitter also. So what made me interested in this company, right? So you would have heard about the Serum Institute, right, in the Corona times because of the vaccines and all, and we all got to know about there is some player who is providing so much in the vaccine world, right? So there is another player, quite a legacy company such as this, who has been in this domain since 1984, right? Right now, so if you look at the kind of relationships it has with the global immunization programs or like the UNICEFs of the world, right? Essentially, it has WHOs as its clients, wherein it's supplying its vaccines, and some so essentially in all the regions wherein it's a supply chain. Essentially, it's giving to this particular institutional firms, and then they have a supply across the world. It has two manufacturing factories in the Baddi and the Laldu area, essentially in the southern Punjab and in the Himachal Pradesh, essentially, and it's covered in right now in almost major geographies. It works on vaccines. The vaccines which mostly it talks about is pediatric immunization. So essentially, babies, right? Essentially, immunization for them. So let's say polio or some other things that the babies need essentially. And it's also another growth area that is working on it is the pharmaceutical formulations. Just talking about a bit about the promoter family, it's been a quietly held business within this Jain family. It's a really well reputed family essentially in the pharmaceutical or in the vaccine world. They have won some awards also. So and it's a firm wherein the next gen is also moving into the business. They have the outline of what their things could be, right? So Rajesh Janji is essentially he has been the quite a head of for this company for quite some time. The kind of R&D assets that they are trying to grow into, and the kind of knowledge, expertise, the global footprints he has, those connections to, which has obviously helped this business till now, and that could help him scale forward also. Other folks in the company, Sandeep Janji, or essentially all close knit into the family, they hold a shareholding of 72.48. It's been quite some constant for a long time. So essentially, this family has good footprint in the R&D business in the vaccine world, essentially good knowledge, good connections, which helps them cater to this particular profile. So what is interesting about this company is, so obviously Serum has grown, but why not this company? It's still a 2000 crore or 2500 crore company. So it had a lot of legacy businesses and all, which it has tried to divest with time and has pivoted towards focusing towards a specialized institutional work wherein they have the plants, they can do good R&D on that, and then try to cater to that particular type of demand and divest all the other things. Let's say they were running a hospital or something, get those things out of the picture. So how right now how they're working is essentially they have this they have the what do I say, the factories in Badi and Laladu, wherein which are already obviously approved by this global institutional buyers. They supply the obviously the stuff to them, the vaccines, the vials and all that, and then they do a global deployment essentially. So this is so a proven model wherein they have the good connections. It's now more about the scalability, what more they can give to them, or what are the more immunization programs across the world, wherein because the uncertainties are growing, right? So we had corona, there could be certain other epidemics or more vaccines required for a healthier world, right? So essentially a proven player in that, a proven connection, and then providing the right set of vaccines. So as I said, there are two divisions that it mainly works on. So vaccine one, which has been going on for quite some long time. So some pharma names, but essentially this is essentially a polio vaccine, essentially, or something for the children. So immunization programs, and then this is more of a cash flow kind of a thing, wherein they have the expertise, they keep on growing, they keep on doing R&D on that, and then the supply chains, the already the contracts are in place. This is where they are trying to grow at some 20-30% per year as such, wherein they are moving towards more high value, high margin business, high margin, what do I say, products essentially, wherein, and one of the things is also that, so let's say they are moving also in this children, and wherein it's a nutrition brand, wherein, so let's say, so kind of the kind of product that Himalaya might be giving, right, for children or something like that. So that is where also this particular company is focusing on, because it has already a niche in children's or a babies vaccines and all. But it's the same periphery of pediatric uh, fulfillment of things, right? And that's it, and it has a global what do I say, presence, and then the right set of uh, geographies it would want to cater to, let's say Indian or Canadian or US or Germany kind of a thing. So that is where this model is right now working on. One thing in this vaccine domain that this company is that an inflection point is. So I would want to uh, uh, take a minute here essentially. So dengue as a disease or as a thing in the world is quite a bit, and then there have been only a very few companies who have been able to produce vaccines. Actually, though what I read was there are only two companies quite some back in 2000s. They tried to launch, but it got failed. Essentially, the vaccines did not work. This company has been working on this particular vaccine for about 20-25 years now. It's almost at the trial 3 stage. It's currently going on with the ICMR, essentially, the Indian Institute, which helps run this things essentially over the board, right? Some 10,000 people have already opted for it. It's currently going on. And it's a very good potential candidate for approval in the coming months, or maybe a few quarters away only. And then essentially, this is where the global need would also occur for a dengue vaccine. And also, one bit about it, it's a single shot vaccine. Earlier ones that were launched way back were like 2 or 3 shots. So that is also right now the efficacy is also looking to be good the way I read the articles. So that is where the company has a good potential to accelerate now, given the base that it has created. So dengue all is a vaccine as a product to be sought to be looked after. As I said, it has good connections, let's say in Canadian market, uh, essentially some strategic partners it had created, or let's say UNICEF or Mozambique or German. So essentially a global footprint of a very old player. It has the knowledge connections across the world. It's more about not taking to the next level. How do we look at the future right now, right? So companies has around 600 crore revenue as of now, trades at around 2,500 market cap, 2,500 and somewhere around 3 to 4x of sales, the market cap to sales, right? So what we need to look out is what kind of orders or contracts it's going to have as a next going period, what kind of visibility that it has. So a few snippets on that, wherein it has got the orders initially, and now it's more about commercializing those things and then the money coming in. So this is where the next year visibility could look like. What I really like about the company, and also with correlating with the pharma as a space right now, is that if you just, it's a 3 monthly chart, and or you might have heard about that Nifty Pharma is hitting an all-time high, right, after a long period of consolidation. Accordingly, this company also listed in, let's say, way back in 1999, did some all-time high in 2027. And it's been a long consolidation period where it's been some bad decisions to turn around to fixing of the creating the LC, the base, and then now scaling up. It's a matter of time. Once they start getting orders, hopefully it should hold up. Also, if you look at the promoters, right, they have held on to the company. The equity capital has also stayed at 6 crore CR. Essentially, they have not even diluted even a single bit. They have held on to the stake, right? And in the recent times, the FIDI is also increasing. What this essentially means is, the way I look at it is essentially, so it's a pharma company wherein the products can be a bit difficult to understand, but and one of the things in FI is it's the MIT has gotten. So they would, so more institutional FI would have done the due diligence more effectively. Essentially, is that product viable for the world? Is that company viable, essentially, right? So that is where it helps me build up a bit of a confidence on this company, and looking at the chart structure also gives me a confidence that okay, right now the base is built up, the company has a future growth visibility, its interest in FIDs is also increasing. It should be a candidate for evaluation. As I said, the FI has increased a bit, institutional holdings essentially. That is built where we could see the confidence. So what are the next areas for this particular company to be looked, right? So as I said, firstly is the dengue or the vaccine as a trial 3 going towards the approval stage and then global rollout. Secondly, the pharma and the nutrition, which has a high margin, more growth in that. Right now it's growing at 20-25%. If you look at the financials, is it able to scale that up with more value products in that particular space? And then the other, what do I say, the optionalities it has, essentially because the approvals that it could get for uh, the plants that it has, right? Essentially, these US ANDA pipelines, essentially the approvals, I'll say, is more things to be looked beyond what it is right now. Some risks. So essentially, some older risks that it had got a observation on its plants earlier. It's currently still in progress. That the way I was able to read the what do I say, the reports or the announcements that are made by the company. So something on those are obviously the risk, right? The commercialization risk or scaling up risk. So that is pretty much standard risk that I see in this company versus the kind of growth visibility that we could have. A very technical one, but essentially what kind of vaccines that it is right now providing. So something related to oleo or some diarrhea, tetanus, and all that, right? So where it has the partnerships with or kind of the commercialization stage, right? So this is where it makes a good case study to read about that. Where is the company going next, or it has already created a base? Where could it go for the next level? That's the last slide. Essentially, the base has been formed wherein it has the capabilities, it has the contracts, and it has a good R&D facilities, and then this commercialization essentially going for the high margin products. So this is where I think uh, the operational leverage, as we say in the world of investing, right, that would kick in. That is what we are hoping for. Yeah, I think that's it from my PPT. Anyone, any questions?
Yeah, good one, Nikhil. So this is a little bit a unique company in that sense. So where do you see this? I think the flying moment will come for this company.
I
2 years
think
down the line, 4 years down the line.
right. So what I see right now is so as I said, right, there are two these main pillars, right? In this particular domain, so there is one new vaccine, which is the commercialization of that. Secondly, more contracts on the existing products. So that is where in the upcoming months or in the upcoming quarters, if we start seeing filings of more agreements between the institutionals ones, that is where the scale up will start happening. Plus it's also quite scaling up this particular I'll just open up, let's say, this also. uh, So if you look at this, right? So this particular so it made a reset in 2022 and right. So if you look at this particular business had scaled up the formulations one. So going at 25%, if it go more at this particular point also towards the broader geographies of the world, right? So this is where the next phase of growth would come in. So this is what I'll be tracking particularly for this company.
Okay. Okay. Yeah, guys. Any questions for Nikhil? Either you can put in the chat or you can unmute yourself and ask. So one of the questions I think in the chat is the vaccine which is for the dengue, phase
Right.
PH3. What would be the time framing for the outcome?
So from the research that I was able to do, it has to somewhere by the end of 26 or max by 27, it should already be approved. It's already the way I've heard about it. It's already in the very good stage of efficacy is also being proved with these trials. So hopefully in the next, I would assume that in the next 6 months or so, we will hear some positive news, at least something on that.
Okay. Okay, I don't think any other more questions as of now. Just look at the chat when it comes, so you can
Sure.
answer from there. So,
Yes.
okay, thanks, Nikhil.
Thank you.
Yeah, so guys, we are here after the 4 presentations for the quiz time, and it's the fastest fingers first, as you all know. And most of the questions are from the slides which has been presented. So be ready for this, and you have to choose the options like always A, B, C, D. So I will be sharing my screen, and then we can start. Let me give a little bit an example for this first. I hope you guys can see my screen. Yeah. So how it plays is fastest fingers first. Watches is worth 250 rupees. For example, the question is how many XXX in this? Guys, this is not the question. This is the example. Okay. So this is just an example for this. You're in too much hurry to win something, but it will not work this way. So how many X? For example, A, 3, and 4. And then, for example, in this, there are 4. The answer is B. You have to type B in the chat box. That's how it works. So question 1 is coming. So be ready with that. So Sigma Advanced Systems recently deployed which autonomous counter drone system? Yeah, a lot of you have got it right. So, stop here for question 1 and move to question 2. The system is how it builds is you have to answer 2 questions correctly to win that voucher, right? Continuous 2 questions. So the next question is Sansera Engineering is undergoing a product mix transformation. What is the percentage of their revenue they will drive? Okay, we can stop here for question 2. Question 3 is coming up. Shivalik Rasayan is executing a structural pivot. What is the future state of the company? Yeah, I think a lot of you are getting the right answers. Thanks for being attentive during the presentations. So we can stop for question 3 here. Question 4 will be coming up. What is the primary twin engine for the RBZ Jewelers? Yeah, again, a lot of you have got it right. So I will have a look on all the options and the answers shared by all of you. So we can stop it here and we'll break for a 10-minute break. And before we rejoin on the same link again, so that continuous 4 presentations are done, let's take a 10-minute break and reassemble around 12:25. And then we'll start with Samarth on this. Okay, let's go for a break. I'm closing the meeting. We'll restart the meeting around 12:25.